which leads us to the last little section in these slides, which is property management. Now, folks, this goes hand in hand. The difference is landlord and tenant, owner and the person renting it. Property management now brings in the real estate broker, right? This third party person who has a relationship, who maintains the property. All the same laws and rules that we just talked about apply here as well. It's just kind of understanding the obligations of a property manager. Some of this is very straightforward and self-explanatory. Some of it is a little more technical, and you'll see that on like the very first slide. Now, remember what I told you too, day one, when we talked about real estate specialization. Some people go into property management with their license. Some people do sales. Some people do residential. Some people do commercial. Some people teach. A lot of different things you can do with your license. And so property management is a very specific aspect. Now, we talked very early on in this class about when a license is required. And we said if you're dealing with, any of the LL Beans activities, list, lease, buy, exchange, auction, negotiate, sell, and then more specifically dealing with real property for others for compensation, then a license is required. Now, we did talk about some exceptions to that early on. And so when we're dealing with employees of a broker property manager, right? The broker who is legally allowed to manage the property typically will hire employees to assist them. And they are not a full-fledged exemption. They can show properties for rent that their boss manages. They can provide lease agreements to the tenants to sign. They can answer basic tenant questions. They can collect rent checks and tenant security deposits, but that's it. They're not allowed to negotiate in any way, shape, or form. Now, the other exemption that we talked about very early on in this class was an employee of an entity owner. They can do anything and everything. They are a full-fledged exemption because they can do everything that an owner can do. Show the property, negotiate, sign the lease, so on and so forth. And I told you the most common things when you walk into a big apartment complex is one of these two things. There's either a broker property manager somewhere in the hierarchy, and you're talking to an employee that's the leasing agent, or you're talking to somebody who's the employee of the entity who owns it, which is a full-fledged exemption. But either way, they can show you the properties for rent and hand you a lease agreement to sign. Now, with that W-2 employee, remember the full-fledged exemption one, they have to be paid on an hourly or salary basis, but or cannot be paid commissions or based on volume or anything like that. How about this question? Let's go back to many, many nights ago. Property managers serve with which type of authority? It is general. Remember, when you are a property manager, you are acting as a general agent because you have the ability to typically bind your client to some things, not all things, right? You can't reinvest their monies. You can't sell their properties. So you're not Universal. Universal, crap. Universal has all the power, okay? So a general agent, we could sign leases on your behalf. We could order repairs on your behalf, things of that nature. And so definitely a general agent in that capacity. Just for funsies, if you were doing sales, if you're representing a buyer or a seller as a real estate agent, you were typically acting in what type of capacity? I like it. Special. There you go. So here is the one technical piece of this section that for some reason or another, they may ask you on, okay? They differentiate between primary function and primary responsibility of a property manager. So if we're talking about the primary function of a property manager, primary function, preserve the value of the property, generate income. That's it. Preserve value of the property, generate income. That is, in a nutshell, what you'd think of a property manager. Primary function. Preserve the value of the property, generate income. If we were talking about your primary responsibility, it's a little more complex. And I'll read it to you and then I'll tell you why. It says, realize the highest return on the property that's consistent with the owner's instructions. Why do we word it that way? Because not everybody maintains investment properties for the same reason. Some people want them for cash flow. Some people want them for building assets, portfolios for the appreciation. Some people need them for tax deductions. Of course, cash flow is good, but it's not always just about the cash flow. Some people own properties that purely break even. Why? They need them for tax purposes, for depreciation. They don't need to make good cash flow because they got business assets elsewhere that make them good money, and they need the tax benefit. So when we're dealing with primary responsibility, realize the highest return consistent with your owner's instructions. Highest return, owner's instructions for the responsibility. Spoiler alert, I'm going to ask you this question again in a little bit to see if you can keep them straight. So, last couple things to talk about, because we're almost there, and so it should time out perfectly. Folks, when we're dealing with property management agreements, every single agency agreement in North Carolina has to be in writing from the offset, except for the buyer agency agreement. And so that includes property management. There is no such thing as oral property management agreements. Have to be in writing from the offset. Now, the other interesting thing about these is while they do have to have a definite termination date, these actually are allowed to have an automatic renewal. And if you think about it, because leases can renew if it's an estate from period to period or a periodic tenancy, so can these. Other things that are outlined on the property management agreement, of course, how you're going to get paid. Folks, it's not too dissimilar from sales commissions. It's just that typically you're getting paid based on your effective gross income. When it's rented, what they're paying each month. And so if you had a property that was $2,500 a month, what you're typically charging is like a 10% management fee or something like that. And so let's say that you got this one house, you're just dealing with 250, right? 2,500 times 10%, you'd be charging them 250 a month to manage it, which isn't a whole lot of money. But what you got to realize, folks, when you have a property management firm with a portfolio of 1,000 homes, 250 times 1,000, that now increases quite a bit. If you've got a huge property management firm, $250,000 a month versus $250 a month. But that's a very, very large portfolio, obviously. But it's not too dissimilar. It's percentages. So the other things outlined are the property manager's responsibilities. We said you're acting as a general agent. Well, what can you do and what can't you do? Are you ordering repairs? Are you the one signing leases? Are you the one handling evictions? By the way, important note here, the property manager can handle the eviction process on behalf of the landlord in North Carolina, but only if they are the ones handling the money. If they're not collecting the rents, they're not allowed to handle the evictions, because that wouldn't be very fair for the owner to call them up and say, evict these people, and them not be positive that there's grounds for eviction. Other things outlined, of course, would be the extent of the manager's authority, as we just stated. What type of reports? Folks, I told you, when you're managing a property, you're basically running a business for somebody. And so they need reports. Are you giving them monthly reports? Are you doing P&L? Are you doing cash flow reports? Of course, the responsibilities of the owner. Is the owner maintaining the insurance? Is the owner going to handle the evictions? Are they going to maintain the property? Or, who's doing what? Ugh. What are our duties to each other upon termination? How will we be paid out? Are there any questions or concerns of lead-based paint or other hazards on the property? These things would arguably be material facts. Of course, remember, long-term leases, we have to give those lead-based paint disclosures as well. Now, the property management agreement, very similar to that periodic tenancy, will typically have a notice, right? Because I told you we can have these automatic renewals. So it'll say something like, well, our property management agreement will go for a year. And then at the end of that year, it will automatically renew for a subsequent year unless somebody gives a 60-day notice of their intent to not renew. Could be landlord, could be property manager. Yet again, of course, property management agreements are property specific, so they would die with destruction of the property. If I'm managing a 300-unit apartment complex and it burns to the ground, I have nothing left to manage anymore. Other things, and yet again, this is stuff that, like, I don't expect you to memorize it, but you can kind of wrap your head around this if you think about it, that it makes sense. Other things that the property manager would do would be what's called a management plan. That's where we look at, what we think we could rent it for, what we think we're going to get for yours. We estimate the budgets, what are the expenses going to look like? What is your cash flow going to look like? And so we kind of piece it all together. Of course, we're going to market the property to find a tenant to live there. And then one of the biggest aspects when there is a property manager is qualifying and screening the tenants. Well, folks, a couple big considerations here. Of course, always have to abide by fair housing. We're going to get into fair housing tomorrow night. So you have to provide what is called a uniform screening criteria that does not violate any laws. For example, it is okay to do credit checks and criminal background checks as long as you're doing them for everybody. You cannot pick and choose who you're doing them for. Also, convictions can be considered, arrests cannot. You are not allowed to deny somebody based on their arrest record, only their conviction record. Of course, a few other things here. Collecting the rents and security deposits, as we stated, maintaining the property, establishing rules for multi-tenant. Folks, a single-family detached home doesn't need nearly as many rules as a 200-unit apartment complex with 2 pools, 2 picnic areas, a dog park, So rules like no glass, no loud music, quiet hours. Of course, potentially initiating those eviction procedures or proceedings. As I said, if they're the ones handling the money as well. Of course, maintaining the records for the properties, preparing the income and expense reports. The evictions we already talked about, complying with all the federal laws, fair housing, ADA compliance, everything in between. And this is where I told you, a lot of this stuff, like if you think about it, it's kind of self-explanatory. Oh yeah, that makes sense. We'd maintain that. We'd oversee that. We'd do that. Now, there is an interesting provision typically within the property management agreement. And if you look at the forms list that you have in your online program, if you were to look at it, there is something in there. And so it's not uncommon for us to put some type of provision that states, well, hey, if you end up selling the property to the tenant, we are due some type of commission for that, right? That's not uncommon. However, please understand that while that may be put into a property management agreement, it does not make it a listing agreement. We would not be allowed to advertise the property for sale just with that little clause that says we're owed something to be sold to the tenant. If we wanted to advertise it for sale, we would need a separate listing agreement. That's very different purpose form. I already talked about the operating budgets. I showed you one earlier. That was what was in that NOI. Folks, these go hand in hand with the income capitalization approach because these are income producing properties. So the method of, valuing them is the income capitalization approach. So the operating budget looks at, the costs, the expenditures, the cash flows, the incomes over a certain period of time. And of course, you evaluate it at the end of the year based on your projections with a cash flow report. And as we were talking about, I think it was Bill that asked it earlier, you could very easily and should do a CMA for a rental property just like you would a sales property. You would just make adjustments based on other rentals. How many bedrooms, how many bathrooms, what did it rent for? What are the features of mine? And so if this one was a 3-bedroom, 3-bath, and I'm renting a 3-bedroom, 2-bath, you'd make adjustments for the rentals just the same. Looking into the neighborhoods and the features and the desirability and all that fun-filled jazz. Now, one thing that is not part of residential leasing, but it is part of commercial, is what we call an upfit. An upfit is where the commercial landlord would be willing to dump some money into making it more suitable for your use. Like, putting in gym style flooring and or, wall mats if you were renting a space for a gym. And then they'll just kind of recoup that in their lease. They could put additional plumbing for a, hairdresser or additional wiring and infrastructure for a doctor's office that may need more bandwidth or things of that nature. A lot of different things go into upfitting, but it's very common in commercial because commercial leases are so long, the landlord will recoup the money in that lease terms from spending, sometimes $100,000 in upfit for the right business. Sometimes they'll even build to suit. If you ever see those signs that say build to suit, if you've got a lease long enough and you come up to them, they say, yeah, we'll build you a whole restaurant as long as you can meet certain criteria. And then they'll just lease it out to you for 10 years. Now, this is also going to look familiar. And I told you there's a lot of redundancies that we've already discussed, which is why I'm kind of going through this so fast. Please vacuum every office nightly. This is the flow of that operating budget that we were talking about earlier to find our NOI. However, if you take it a step further, because I told you NOI never includes debt service. So we stopped at NOI in the previous example. A cash flow report will subtract out debt service, because if you take your NOI minus your debt service, what you're left with is called your before tax cash flow. And then, of course, after you put aside money for taxes, you are left with your after tax cash flow, which is expendable income from a business point of view. So a cash flow report looks almost identical to the operating budget, but it takes out the debt service and leaves you with your cash flow. Also, things that we've already talked about. A lot of this is not new. Equity. Folks, what is equity? I'll take that answer. Anthony says, portion of the home you own and value. Bree says different amount paid versus value. Yeah. Remember, equity is what you could sell your property for minus what you owe the bank. That's your equity. Now, the ways that equity increase: appreciation, the property getting more valuable; debt service, paying down your principal balance; and capital improvements, doing things to make the property more valuable. All of those increase your equity. Now, leverage, folks, is a very powerful concept in the investing world. It is the use of borrowed money to finance an investment. And so I'll give you an example with this next slide's numbers to help you understand how powerful leverage can be. If you look at buying a home for $100,000, and let's say that you had $100,000 in cash in your bank account. So you buy this property for $100,000, you hold on to it, and you eventually sell it for $125,000. Well, folks, you made $25,000 in profit. Now, I'll get to the return on your investment piece more in just a second. Well, actually, I'll get into it right now. The way that you calculate the return on your investment is what you made divided by what you paid. So in this example, understand your profit is not $125,000 because you got your $100,000 as a return, like what you invested, but then your profit is $25,000. So $25,000 divided by what it costs you to invest in this property, which was $100,000, that is a 25% return on your investment. That's how you calculate your rate of return. What you made divided by what you paid. So leverage, folks, let me give you a prime example here. If you took that $100,000 that you had in your bank account, and instead of buying one property for $100,000, you split it 5 ways, and you bought 5 houses. 1, 2, 3, 4, 5, putting a $20,000 down payment on each, and then borrowed money from the banks on all the rest. And you eventually sold all of those homes for this $125,000. Now, you've got your $125,000 after you sold all the things, all that was said and done, $25,000 in profit on each overall times 5 divided by your initial investment of $100,000. Now you get 125% return on your investment. That's what leverage is in a nutshell, folks. Using other people's money to make yourself more. And there's even more that would come into this because this is an oversimplification. You'd have cash flow, you'd have depreciation, you'd have appreciation. So you'd have way more going for you. Sure, you would have debt service, but you'd probably have a tenant paying all that debt service. So that'd be irrelevant versus owning it cash. So that's just an example of leverage. But once again, percent of profit, what you made divided by what you paid. Because, you know, it's like you buy a can of soda for $1, you sell it for $2. You didn't make $2, you made $1. So you got to understand the difference between what you actually sold it for is not profit. They're not going to ask you to necessarily do the math like I did, Bree, for leverage. You just have to know that leverage is utilizing other people's money to make money, keeping more in your pocket. That's all it really comes down to. Yeah, there you go, Cardone. Folks, just a couple slides left, so I kind of want to just finish this up. We've already talked about cap rates. I'm not going to reteach this to you. This is just showing you, yet again, NOI divided by cap rate tells you the value based on the income capitalization approach. We've already discussed this. No need to go over it again. The other thing that comes into play is, of course, the risk management side of the property management world. When we're dealing with risk, we've got to decide what to do with it. Do we keep it? Do we avoid it? Do we insure it? Do we, you know, all these different things are options. Because if you have a pool, you add risk. If you don't want to have a pool, you lose that profit, but you also lose that risk. And so we have to decide, you know, what risks are worth it? How do we cover those risks? How do we prevent ourselves from being in, you know, having big issues with it? And so that's part of the thing that we'll do with the property owner. We will help them figure out the adequate insurances, how to maintain risks. And of course, when we're talking about insurances, fire and hazard, liability, casualty, loss of life. I mean, just all the same typical insurances, nothing too crazy there. We've already talked about calculating the commission. This is just an example. And of course, I don't know where rent is $475 a month, but in this instance, for 75 months, if it was a property management fee of 8%, that'd be $38 a month. If we're looking at it from an annual point of view, that'd be $456. Very small numbers, but same thing. Yeah, right. That's crazy to think about that that's a thing. So let me ask you a question. See if you're paying attention. True or false? A property manager's primary responsibility is to preserve the value of an investment property while generating income for the property owner. That's where I told you to be careful, folks, is the technicality here. The responsibility versus the function. Responsibility versus the function. The property manager's primary responsibility is to realize the highest return on the property that is consistent with the owner's instructions. The function, preserve the value, generate income. How about this question? What is the formula for percent of profit? There you go. What you made divided by what you paid, or in other words, profit divided by purchase price. So in this example, if your profit was $25,000 and your initial investment was $150,000, you would take your $25,000 divided by your $150,000. It would be a rounded 17% profit. Whoop, whoop. Folks, that is the end of those slides.